Hello, everybody. My name is James Duade, and I am here today to share my investment thesis on Abaxx Technologies. And I will also have an article which will discuss my investment thesis. But today I wanted to focus on and give you kind of a demonstration of the Excel file that is attached to the article and kind of walk through that like a presentation to discuss my thesis on Abaxx. So as I mentioned, my name is James Duade. I'm an individual investor. I have been invested in Abaxx and also through New Millennium Iron, which was acquired by Abaxx Tech for over 2 years at this point. And I felt like Abaxx is finally at the point where we can kind of discuss potential target valuations based on the rollout of their exchange and clearinghouse in the near future. So this file, just to give you kind of a brief overview, I'm including this here so that you can see what my assumptions are, my valuation targets are, but I also wanted to provide you with a file so that you had a resource that you could take a look at. I've spent a lot of time, as you can probably tell, from aggregating all of this information together. Abaxx is a somewhat complicated story. I'm sure many of the people in the management, including Josh Crum, would probably agree with that. And so I think that this file helps to put together some of those pieces that may be difficult for some shareholders to piece together themselves. So I wanted to give this file to investors so that they could not only take a look at that as a resource, but they could also modify the assumptions and say, you know, James, I think what you did is great, but I really don't like your assumption here or your assumption there, and I want to modify it and see what would happen to the target valuations that you have. And so I'm giving you that tool to be able to do that. So first thing is I've got this table of contents here. You can see that there are these hyperlinks. If you click on any of the hyperlinks for each of the sections or the subsections, excuse me, it'll bring you to that tab. So for instance, I just clicked on the target valuations, but it's just an easy way of kind of organizing everything. I also wanted to draw attention to the tab key over here. You can see the different colored colorations that we have for each of the sections that I have in the spreadsheet. There are about 18 or 19 different tabs that we have here. So I thought that that might be a way of kind of organizing it a little bit better. So just a note about this presentation. I am a huge fan of Will Ferrell, and I think one of his underappreciated movies is Other Guys. There's a character in The Other Guys. His name is David Ershon. And while he's kind of a villain in the movie and somebody that you shouldn't really look up to, he does have a good quote towards the end of it about how to tell a story. And I thought that that would be kind of funny to insert here. And so I'm going to start at the end, give you the valuations, and then I'm going to bring you back to the beginning, discuss the general corporate strategies here, some basic information to kind of set the tone, build the foundation. Then we'll talk about the LNG contract and the LNG story as a whole. We'll get into the margin of safety discussion, and then we'll talk about kind of bring it all together and talk about future strategies for the company. So one thing that I want to note is that the overall thesis here is really that Abaxx is an asymmetric risk reward profile, meaning that the margin of safety is such that you really don't have a lot of downside risk for the stock. So you have sort of a nice support level there. But the upside potential, once the exchange and the clearinghouse is approved, is quite frankly enormous. And you'll see that in these valuations here. So some of the parts is a common strategy for margin of safety. Margin of safety, for those who may not be aware, is a term that Benjamin Graham made popular. it's effectively saying that if you're going to build a bridge that should hold a 10,000 pound vehicle, you want to build a bridge that can hold 20,000 pounds so that you have that margin of safety in case two vehicles go across or something happens that's unforeseen. And so it gives you that extra cushion so that you have something to kind of fall back on in case things go awry. And so you can see down here that I do a pretty detailed sum of the parts valuation, which I'll discuss in a little bit. And my target valuation here, so the downside potential, I think, is $4.34. That's about a 30% upside from $3.36, which is what it closed at on Thursday, July 15th. Over here, you can see my rationale, which is that this sum of the parts includes shareholder equity as of March 31st, cash from the May bought deal, which we'll discuss in a moment, the Tacora Port royalty, a 3% option value on K-Mag Newtac, which I'll discuss in detail, as well as the exchange and clearinghouse infrastructure. I give zero credit to the technologies, even though I think they are quite valuable. Basically, the only thing that I'm valuing here is if you were to liquidate the company, what do you think we could get in this market environment? So that's the downside. The upside, I think, which is based solely on the LNG contract being put in place, and we'll talk about that in just a little bit. But the upside, I think, is $15 to $40, as you can see here, in 1 to 2 years' time. And the way that I derive that, and again, I'll discuss these in greater detail, is a 20% target of their liquid natural gas TAM, or total addressable market. And so I think that they could potentially hit within 1 year of launch of their exchange, which is supposed to launch in September. They could get 20% of that total addressable market. And then I think within 2 years, after they've built it out, volume starting to increase, I believe they could potentially hit 50%. And so that's how I'm getting those figures there. And then I'm multiplying those sales values by a price to sales multiple off of an industry peer group. And so we'll discuss that in greater detail as well. So that's the end. So if you just wanted to see the end, you can drop off here. You can also read the article. But now I'm going to kind of dive into some of the beginning and lay the foundation and discuss the LNG contract as well as some of the parts analysis. So fully diluted shares, this is a little bit complicated, but effectively there were close to 70 million fully diluted shares in December when Abaxx initially IPO'd. And so when we take our IPO, that amount has been added to over time because we had the May bought deal, and they've done some warrants that were exercised by management. But effectively, if you add in the total share count from the March CEDAR filing, incentive options that have occurred since December 17th, new bought deal shares, new bought deal warrants, and I'm assuming that all these bought deal warrants are exercised, which is not a given. And the bought deal warrants are at $5.10 Canadian. That would give you a total of 79.983. So you can effectively round it to just call it 80 million shares. That's how I see the total fully diluted share outstanding count. Bought deal funds. So this is something that was recently exercised in May. I think it was May 14th or so. And what they were able to get was 24.7 million in total. They had president's list of approximately 8.6 million. So this would have included investors who are close to the corporation, who effectively Abaxx was able to get to invest in the bought deal, so they didn't need the investment banks. And then they had the non-president list, which would have been investors that the investment banks were able to bring into the fold for Abaxx. And so there was a 6% fee for anybody who was on the non-president's list and 3% fee for anybody who was on the president's list. when you net out those fees, effectively you get to $23.5 million, which is about 29 cents per fully diluted share. And again, I'm using the fully diluted share count over here. So the Abaxx balance sheet for shareholder equity, you can see that, and I'm basically just pulling from the CEDAR filing that occurred in March. The total shareholder equity for that March, if you just divide it by the fully diluted share count of approximately 80 million, is approximately 16 cents per fully diluted share. So you'll see this value as well as the bought deal fund value again when we talk about sum of parts. And I included a kind of a screenshot as a source just so that you could see where I derived those figures. A note about ownership. So ownership here, and I pulled this in a previous blog post. I haven't really updated it since December, but effectively you can see this is, you get a sense of who owns what. You can see that the yellow is individuals who are associated with management. So we've got Josh Crum. There's he owns 17.4%. He upped his stake in May. I know that. He also has done some recently bought shares on the open market, I should say. Then you have the other management, not including Josh Crum or Andy Fedak. Andy Fedak has Luna Partners LLC and 7H Partners ULC, and they own several million shares between the two of them. And then you also have some, excuse me, you also have some notable angel investors like Kyle Bass, Lucas Lundeen. It's never been disclosed as to what they own, but we know that Kyle Bass is likely the second largest shareholder in Abaxx. Robert Friedland, it was mentioned in December or January that he owned about 6.5% of the company. So you've got a pretty good shareholder roster. And since there's only approximately 80 million shares that are out on the market, it's relatively tightly held. You've got a pretty good percentage of shares that are locked up with either management or long-term shareholders. So this is something to keep in mind as Abaxx starts to transition from a pre-revenue company to a revenue company. Eventually, they're going to be included in indexes, funds are going to buy them, and there's going to be a small float. And so when you have these indexes or funds that are starting to add Abaxx in a notable way, that's going to drive demand for the stock. There's going to not be a lot of stock out there because the float will be relatively small. And so you could see some pretty large jumps in share price as funds and indexes are adding Abaxx. And so Russell 2000 would be something that we would want to keep an eye on. They would be potentially included around June 30th of next year. There's some other indexes also that they could potentially hit as they get closer to listing on the NASDAQ, which would potentially occur in late Q4 or Q1 of 2021. So that's the general corporate section. Let's talk about LNG for a sec. So I've included some links over here. I try to include sources wherever possible. One of the sources is this wonderful presentation that was given by Potent & Partners. They did an LNG webinar in the end of April. I've provided some screen grabs from that, which I thought were relevant. I would highly recommend taking a listen to that. I also have an article over here about Asian LNG demand and what that's going to look like over the next decade. And then the January 2021 Abaxx presentation has a number of slides on it discussing the LNG contract and kind of the thesis behind that. So I have a slide down here that's relevant. LNG, there's been a number of people, including Luke, who's a wonderful resource for Abaxx. He's put together 2 articles on LNG and carbon credits, and I highly recommend people take a look at that. I'm going to cover it at a pretty high level. I'll discuss in the article as well. I put some some detailed notes over here if you want to take a look at that as well. But at a high level, the idea here is that LNG produces significantly less greenhouse gases. I think it's 40% less greenhouse gases than coal, and the infrastructure for natural gas is currently present, so it can be leveraged by a grid in most countries, whereas renewable energy is not quite there. And for these reasons, effectively LNG is known as a transition fuel that can allow most countries to go from hydrocarbons to renewable energy sources. The issue with LNG is that historically, there was a small group of people, or excuse me, a small group of players in Asian countries who were buying LNG. And so that small group of individuals kind of created the infrastructure for it. They put in place a large number of contracts that were long-term contracts. And that has evolved over time so that going from, say, 90% long-term contracts to spot rates has significantly changed the market. And so you have this move where now 40% of, which was discussed in the Potent Partners webinar, approximately 40% of the LNG market is now spot rate. This is pretty significant because it means that there's kind of this liquid market that's out there. The difficulty here is that there's no good benchmark for spot prices. So I included a slide over here that discusses what players in LNG are using to hedge their risk for LNG. And so there's, the Japanese crude cocktail, or JCC. There's the Japan Korea marker, and obviously these are in Asia. There's a Dutch Tidal Transfer Facility, or TTF, that's a mouthful. That's in Europe. You got Brent crude oil, which is North Sea in Europe. You got WTI in North America. You got Henry Hub in North America. None of these are physically delivered contracts that are the basis for LNG, and that's why you don't have a dominant player. Abaxx is trying to create that benchmark contract so that you have the equivalent of, say, a WTI in North America, or a Brent in Europe, or a Murban in UAE. That would create kind of a benchmark price that would be owned by Abaxx, as opposed to, say, CME or ICE, who are the dominant players in oil and gas hydrocarbon contracts at the moment. Doing that could be extremely valuable, because the WTI contract for CME is worth billions of dollars. They do a high amount of volume, and we'll discuss that in a moment. And so I've got this slide down here that kind of shows that right now there is no dominant benchmark, and the industry is kind of using a variety of different products that don't really get at what they need. So the goal, and that's why Abaxx has such strong senior leadership who have developed markets and exchanges before, they think that they can be a major player in LNG, and they're going to be in Singapore, where the majority of the Asian market would do business, and obviously the majority of LNG is kind of being imported by Asian players. And so Abaxx thinks that they could really disrupt that market and be the major player, create a benchmark, and if they can do that, then they would be executing on an idea that is worth not just $1 billion, but multiple billions of dollars. So let's talk about LNG contract. So this is how I derived my valuations on the target valuation slide. So Abaxx thinks, and they've posted in their January 2021 presentation, that the LNG contract, the total addressable market for that contract, is 500 million US a year, which is huge. And if they could hit that, then those figures that I was discussing earlier could come to fruition. So that $38.76 is effectively 50% of the total addressable market from a sales perspective. And so I created this chart over here that effectively looks at the assumption of a $500 million total addressable market with an 81% Abaxx ownership exchange, and then an exchange rate of $1.26. This will fluctuate over time as the sheet is updated, and then based on this total fully diluted share count. So a note on that total addressable market. So the January presentation indicated that that TAM is effectively looking at 10,000 lots traded per day on the natural gas contract, with a notional churn, meaning that each of those trades is eventually traded 50 more times between partners. So the initial person who trades that contract may then trade it and retrade it and trade again up to 50 times. And so 10,000 times 50 equals 500,000 contracts a day. And then they believe that that would result in $3 to $5 million of revenue, US dollars per day. So if we look at that $500,000 trades per day, and then we multiply that by the total trading days in a year, which would be the network days between a single year minus 10 holidays, you get 251 days. So the total trades per year would be 125.5 million. If we divide that by the total addressable market of 500 million, you get a per trade value of $3.98. Then you would divide that, because you have a buyer and a seller, by 2. So that would give you about $2 per trade. So industry standard is generally, once you have a mature market, is $1 on each side. Because it's a newer product, it's just getting started. They're probably going to charge a little bit higher. So this seems within the realm of possibility to me. So I think that I'm going to keep that total addressable market. And again, they have some pretty senior guys who created that TAM, and so I trust their assumptions. We can also take a look at the 10K for CME and see that in 2020 and 2019, the total number of contracts that they traded in a given year was 639,000 for natural gas in 2020, and was about 530,000 in 2019. So that the fact that they're trying to trade 500,000 trades per day kind of jives with what CME does for natural gas. So one other note here, I think that this is something that you can definitely play around with. If you think that this total addressable market, by the way, is completely ludicrous, and you say, you know, James, I like what you've done here, I think this is great, but I think that 500 million TAM is unrealistic. Well, I've given you the option to reduce that by $10 million per increment. And so you could say, hey, I think it's worth 300 million and not 500 million. And if you do that, you can notice that all these cells are dynamically changing. And then the per share value, if Abaxx hits 50, is 23.26, which effectively reflects $1.91.2 times the peer group multiple of 12.16. So I've given you the ability to change that if you think that my assumptions, or Abaxx's assumptions for that matter, are just way off. but feel free to play around with that however you would like. And let me know in the comments on the article if you think I'm way off base. So a note about the exchange peer group multiple. So what I did here was on July 14th, I went in and I took a look at a variety of exchanges, and I looked at their price to sales. I looked at their price to earnings, gap earnings, so that we could kind of take a look and say, okay, well, what could Abaxx realistically get from a price to sales multiple or a price to earnings multiple? 12.16 is about what we got here. Hong Kong Exchange, for some reason, I'm not exactly sure why they have such an incredibly high multiple. It does skew it a little bit, but I wanted to include them because they're in the region, as well as Singapore Exchange. Price to earnings, 28.75 is kind of reasonable, and that's what we took a look at here as well. So next up, one of the major drivers of revenue for ICE and CME, who own some significant oil and gas futures contracts, is data services. And I know Josh Crum had mentioned on Twitter when I kind of posted this initially that they didn't want to take advantage or exploit their customers and use the customer as a resource. That said, I think that they have the ability to sell data to data aggregators like Platts or other institutions. There are ways that they could create revenue through data services. And what I wanted to show here is that as a percentage of revenue, CME gets approximately $1 billion, or I'm sorry, CME has about $500 million in revenue every year from market data. ICE gets almost $800 million a year from market data. They, as a percentage of their revenue, it's 10 to 15%. So it's a significant driver of revenue, and it's not something that I included in the valuation, but I think it's something that investors should think about, that they would have the capability of creating data sources for various markets that would not exploit their customers, but provide value-added services in the form of data. So just something to kind of think about. The sources for this information I've taken screenshots and put them over here so people can take a look at that. They can look at the descriptions of what market data is comprised of for both CME and ICE. So take a look at that, kind of think about it. If you have questions, put them in the comment section. Also, I've put carbon offsets. This has been a hot button topic here. I wrote a blog post a while back in November after the NML RTO transaction was announced. I had asked Josh a question on the NML RTO conference call, and he kind of indicated, yeah, we're thinking about using our SaaS for ESG related activities, and that got me thinking about air carbon and the potential partnership there because of the connection with Tom McMahon. And so I had written this discussion on carbon offsets. I think it's still relevant. There are some helpful resources that I've included over here about what carbon offsets are. And like I mentioned, Luke, who is another shareholder in Abaxx, he's written some pretty good Substacks on LNG and the Abaxx exchange, as well as voluntary and compliance carbon markets. And I think that those do a better job than I could provide service to it. It's definitely something that Abaxx is looking at right now. And what you really need to know is that the way that carbon offsets are thought about with LNG, so that you can make LNG carbon neutral, is that if you're, say, buying a cargo of LNG, what you want to do is effectively offset the trip from the liquefaction plant to the regasification plant where the LNG is delivered. So that ship that might travel from, say, UAE to Japan, what is the carbon footprint of that travel for that ship? And so my understanding is that Abaxx may have some type of, say, calculator where you can take a look and say, okay, from this port in UAE to this port in Japan or Korea where the LNG is purchased, the carbon footprint would be this, and I need to buy X number of carbon contracts to offset that. Obviously, this is becoming more and more of relevant for the market today. There seems to be a lot more interest in it. It's definitely something that's growing. And my understanding is that some of the first trades that could occur on the Abaxx exchange may be carbon neutral in that respect. So something to keep an eye on. And again, I didn't include any of the carbon offset aspects in the valuation. I literally was just looking at the LNG contract, but this is definitely something that could be value added for shareholders as well. I've included a lot of resources here. If anybody has questions on this, feel free to kind of ping me in the comment section of the article. Yesterday, Base Carbon was announced as the first potential spin out company from Abaxx. So I've put some comments here in the spreadsheet. I'll try to discuss this in the article a little bit. Effectively, the high points are that Abaxx is going to create a spin-out company called Base Carbon, which stands for, pardon me not being prepared here, but it's benefits of air, sea, and earth, or BASE. And that company is effectively going to be focused on carbon credit trading and carbon credit measurement, reporting, and verification. It's going to leverage Abaxx's SaaS and Web3 productivity tools, which I just recently wrote an article about how Abaxx could potentially use that and spin out businesses. In a way, you can kind of think of them as a royalty generator company that uses its SaaS as opposed to resources like gold or iron ore or whatever. So they're kind of like the Franco-Nevada of tech. That's the way that I would sort of put it. They can use the ID++ and SaaS Web3 productivity tools, which would then drive a 2% revenue royalty back to Abaxx, and Abaxx would potentially retain the equity or maybe even spin that out and dividend it to shareholders so that shareholders would own a pro rata amount of Base when it eventually IPOs. There's a lot of kind of questions about how that's going to work, and I think we just need to give Abaxx time to let it play out. One thing that I think is of significant note here is the potential for Base. A good comp for Base would be Carbon Streaming Corporation, which as of yesterday had a market cap of 253 million USD. And based on the description of their business, which they started in June of 2020, it sounds kind of similar to Abaxx, and maybe even Abaxx would be have a better market, have an easier time of addressing this market than Carbon Streaming Corporation. I haven't really done any DD on Carbon Streaming Corporation just yet. So if anybody has looked into that and has some thoughts on how Base would compare, please post those in the comments. I'm just kind of including this because it was a significant disclosure that occurred yesterday. So over here, I have some of the discussion on the tech. This is more included just for people's awareness. The way that the tech is going to be monetized, as I mentioned before, it's kind of, I think Josh has a prospector generator model in mind where they own the core technology of ID++ and all the applications like the sign and verify, the video, the vault, but then they're able to spin out these business ideas that leverage those tools, and then they'll retain maybe an equity interest in those businesses and have a revenue stream that comes back to them through the 2% royalty. Since I've kind of looked at DocU before, I think this just gives people a perspective on how highly valued these companies are. DocU has a price to sales of 27, which is pretty high. Their PE multiple is pretty high as well. And so I think the idea here is that, you know, if you were to just do a thought experiment and say, okay, Abaxx could take 1% market share from DocU, it's a $45 billion total addressable market for online contracts in a given year. What would that look like for Abaxx? And it could potentially be, you know, $7 a share, maybe even more, if they could spin that out and get some traction there. There are some competitors in the space aside from DocU. There's Dotloop, there's HelloSign, which is by Dropbox. Dotloop is for Zillow, kind of signing like real estate contracts. Google Docs and Adobe are obviously in the space as well. There was a pretty good discussion about the potential for the sign and verify application that was in the Dimensions of Abaxx conference call, excuse me, the Dimensions of Abaxx podcast, where Josh kind of described sign and verify as a notarized document that could be potentially used in a court of law. And if that were to occur, then, you know, it could potentially replace DocU overnight. I think maybe Eric Townsend said that. So something to keep an eye on. And again, I didn't even include any of this in my valuation. I'm just purely basing it off of LNG. Also, I mentioned that I had an article recently. This is really just for fun. There were some test wallets that were on Ethereum that kind of give you an idea of what they could maybe have in the pipeline as far as ideas for spin out businesses. Like I said, this is kind of just for fun and more of a thought experiment on what they could do, but you have some data behind it. And, you know, I did a fair amount of digging on it, and I wanted to provide that information to people. So all of that is the business. Now let's get into the sum of the parts, which is really where the safety net is for investors. So there's a few different parts here. I've already talked about the equity that shareholders own. I've talked about the bought deal, but there's some other assets that are owned by Abaxx that aren't really reflected on the balance sheet because they were written down by NML prior to the RTO. So you have the Takora royalty and port, and this was initially announced in late 2018 by NML, where they sold port access to Takora, which owns the Wabush mine, which they purchased effectively from Cliffs when Cliffs left Canada in 2014 to focus on their North American, or specifically United States iron ore in the Mesabi Iron Range and the Marquette Range in Michigan. So Takora kind of came in, filled the void, thought that they could utilize that Wabush asset. They wanted to reduce manganese, which was kind of a sticking point. They decided to get rid of the pelletizing plant that was in Sept Isle. And they bought this port access from NML, 6.5 million tons for $4 million. Plus they gave NML, which was then gifted to Abaxx through the RTO, a 10-cent per ton royalty through the end of the port contract, which is in 2033. So Takora right now is producing like gangbusters because the price of iron ore is at all-time highs. It's about $220 a ton, which we'll talk a little bit more in just a moment. $220 a ton for 62% FE. So what I did here is I basically said, okay, if you have 4.5 million tons of production, they're still ramping on Takora, but then you have 6 million tons thereafter. That would be about 76,500,000 tons. 10 cent per ton royalty, you could basically say, okay, that's going to be $7.65 million over the lifespan of the contract. If we do a discounted cash flow analysis using 8%, and you know, you can choose to say 10% or whatever you want, but I put 8%. So the present value of future cash flows would be 4.6 million. So then that goes into our equation for the sum of the parts as 4.6 million Canadian. Then Abaxx also still owns 8.5 million tons of port access that's not being used right now that they could theoretically sell. So this calculation basically says, okay, based off of the previous port sale and the port royalty, what would this value be? And so it effectively adds in the per million ton port value multiplied by 8.5 plus the potential for a royalty stream on those tons. And so that gives you 11.25 million Canadian. So that goes into our sum of the parts as well. Next up, we've got the KMag NewTAC. So I could probably talk about this for a couple of hours. I previously was a shareholder of New Millennium Iron from 2011 to 2015. I had studied New Millennium quite a bit, studied iron markets quite a bit. What I did was I recreated the feasibility study here for KMag, and I was able to come up with a present value future cash flows for the KMag NewTAC project of $3.4 billion. So what's important to note here is that New Millennium Iron has its roots in the Iron Ore Company of Canada. There was a founder named Bob Martin. Bob Martin was a geologist in 1960, 60 years ago. He took a plane out to Shefferville, which is kind of out in a remote region of Canada. In fact, it's kind of straddling between Quebec and Newfoundland, Labrador. And he decided to take a look at a couple of deposits that were there for the Iron Ore Company of Canada. He looked at LabMag, he looked at KMag, but he was specifically focused on LabMag. And he discovered one of the largest iron ore deposits in the world. And it wound up being an iron range, which they called the Millennium Iron Range at a later point in time. And it effectively mirrors the large taconite range in Minnesota called the Mesabi Iron Range. And so there are billions and billions and billions of tons of iron ore there. I've listed out here as to what they have that's been drilled and proven, which is about 29 billion tons. And so he kind of kept a mental note of it. In the 1980s, Iron Ore Company of Canada let those claims on LabMag and KMag and all these other properties go, even though they had explored them and spent quite a bit of money on them. The reason why they let them go was because other deposits in Brazil and Australia that had large DSO deposits were found to be very profitable. Those discoveries were then used in European markets and Asian markets, and it really crowded out high-priced producers like Shefferville, which had a DSO project at the time. So IOC effectively abandoned those projects. In 2002, 2003, Bob Martin and a group of other IOC, former IOC execs started New Millennium Iron, and they restaked the claims. They drilled them out. In 2011, they signed a contract with Tata Steel to do a $50 million feasibility study on both LabMag and KMag. And at that time that they signed that contract, New Millennium Iron was worth $1 billion, $1 billion US market cap. When they did the RTO, the value of the company was about 10 million. So it kind of fallen. So it's pretty much feast or famine with these projects. And if you're too early, that's unfortunate. But they did spend, as I mentioned, over $50 million doing a feasibility study, which finished up in 2014. The unfortunate part about the feasibility study was they had kind of their bellies were too big for their eyes, and they put in sort of all these bells and whistles that added to the capex, and they really shouldn't have done that. They should have focused on a much lower capex project. In 2016, they redid the feasibility study for KMag, And for KMAG, they effectively used all the data from the 2014 pre-feasibility study, but they said, okay, we're going to leverage existing resources like the rail line that's currently there. We're not going to do a slurry line. We're going to kind of think more efficiently about what we can do, scale back the project. And so what I did here was, and you can see all these screen grabs, which effectively show the assumptions that I used from that 2016 feasibility study. I recreated that, but I modified it slightly to update the price, because the price in that 2016 pre-feasibility study was about $70 for 62% FE. And as of a couple of days ago, 62% FE benchmark was $218. So long story short, I updated the 62% FE benchmark to 150, which is about $75 below, or $70 below what the current spot price is. And then I modified the pellet premium to $35 up from $30, which is where it was in the project. If people have questions on this, feel free to let me know and I can discuss it in greater detail. One note is that I used a discount rate of 10%, and then I used a probability or an option value of 3%, saying that if this project were to go to production, you know, we have a 3% chance that it'll go to production, which I actually think it's much higher than that at this point in time. But for the sake of argument, I'm just saying, okay, if it goes to production, it would be about 3%. And so if you run those numbers, you get 102 or almost 103 million for the option value for new TAC. I've also given you the potential to say, okay, you can select your discount rate and say, you know, I think 8% discount is much better, and you can see how that would impact the share price. Or you can say, okay, I think the probability is actually closer to 10%, and that really juices the numbers. You can also say, you know, $150 seems unreasonable, James. Let's try it with 130. And then you can see how that would impact the numbers as well. But for the sake of argument, I'm going to say it's 150 for today. Next up, we have the additional taconite resources. So as I mentioned earlier, this is there's a Millennium Iron Range. What I showed you here is just for KMAG. The two most mature projects are actually KMAG and LabMag. The reason why NML did this is because there's some issues between the two as far as the governmental problems that can occur. So like Labrador wants pelletizing to just be in Newfoundland and Labrador, whereas if you did it at KMAG, you could do the pelletizing in Sept Isle and still keep it all within Quebec. So some things to keep in mind. I didn't include anything other than the KMAG new TAC project and the valuation for some of the parts. Next up, and pretty much the last part here, is the value of the exchange infrastructure. I included a link here as well as a relevant quote from an article in 2013 where the last exchange and clearinghouse was sold to ICE for $150 million US at the time. And it basically said, you know, we're not interested in the exchange other than the infrastructure that they've developed. The time involved is significant. The effort involved is significant. And in order to do that, we're going to pay $150 million to kind of jump the line and buy an exchange as opposed to do it ourselves and wait. So since that was in 2013, I've inflated that 3% annually times 8 years. That gives me $237 million when we inflate it for Canadian exchange rate. And then the Abaxx Tech interest is 192 million because they only own 81%. And then per fully diluted share price would be 241. So when we take all those things together and we add this up, and all these values are connected to where the other previous values are on the spreadsheet, you get $4.34. And so you can kind of see that lined out here. Lastly, For fun, I have a Abaxx and Bitcoin correlation. Some people have noted, hey, is Abaxx correlated to Bitcoin because of their connection with distributed ledger technology? It doesn't seem to be the case. There's a weak positive correlation, and there's a much stronger correlation with the S&P 500. In fact, S&P 500 has a stronger correlation to Bitcoin than Abaxx. So, okay, anyway, I'm pretty much done with the presentation. Thank you so much for listening to me. Hopefully you have a much better sense of what the potential share price for Abaxx could be. And please feel free to read the article, put comments in, and let me know what you think. Take care. Bye.